welcome back to the channel. Today we're going to take a quick look at Nike to understand if the market is overreacting or not based on their earnings call that happened last Thursday on June 27th. If you're new around here, I wanted to quickly point out that you can follow along to any of my valuation videos. All you need to do is scroll down to the description and there will be a link for the model. You will need to make a copy of this model, but that will then grant you edit access so you can follow along and adjust my assumptions as needed. If you haven't been following Nike, the stock actually dropped like a rock. It went down 20% in just a day. This was mainly driven by the company's projections for 2025 and management stating they expect a difficult 2025 with mid-single-digit declines in revenue. But let's just jump right into things. I pulled together a quick DCF. The price drop does not appear to actually be related to 2024. We'll hit on this real quick. They just released their performance for 2024. The company didn't perform tremendously, but through 9 months of the year, so through their Q3, they were actually on pace to have no revenue growth for the year, and that's exactly where they finished. So I think that was kind of already priced in. So taking a quick peek at the revenue schedule by products, you actually see that there's not even any large mix shifts or anything happening there. Footwear is still dominating as their largest driver, and then followed by their apparel business. So let's quickly jump into the DCF I pulled together and see if this 20% pullback in the share price is justified or not. For this model, I've kept things simple. I want to understand, is the market overreacting or not? So let's talk sales growth first. Let's assume this is a bad year for Nike as they anticipate, so we have a 5% decrease in sales for 2025. Then we have a year of no growth, followed by nominal growth of 2% and then 4%, and then we kind of steady out around 7%. This is pretty modest, slightly above inflation for the long term, so you can get there mostly through price increases, more or less. So I think this is a pretty safe assumption. Next, let's take a look at COGS. I've held this completely flat. We're going to assume that the cost to manufacture their products is not going to increase or decrease significantly. Next is demand creation. If you've never looked at Nike before, you may have never come across this line item on a financial statement. This is simply their endorsement costs. So what they are paying to athletes to be exclusive to Nike. Caitlin Clark's $10 million deal? Yep, that's going to flow through here over the life of that contract. I've left this at 8% of revenue. It seems to actually have stayed pretty steady in recent years. But now onto the big unknown, SG&A. This seems to be pretty high at first glance, around 24% of revenue. I understand there is a lot of marketing that Nike does, but it's also grown pretty quickly in the last 5 years, going from $9.5 billion to $12.3 billion, making me think this could be more corporate costs than marketing. So in this model, I'm going to make the assumption that Nike understands that they are no longer a growth company and need to control their costs. So I've actually layered in a 2% reduction annually for the next 4 years, and then it steadies out at around 16% of revenue. So in absolute dollars, this gets them back to around that $9 billion they were at 5 years ago, and then it actually slowly increases once revenue picks up at that 7% growth rate we have layered in. So let's take all of these inputs and let's see what our model is telling us. So revenues are going to go from $51 billion in 2024 all the way to $81 billion in a decade. Off of this, the cash flow will go from $5 billion in 2024 all the way to almost $12 billion in 2034. So with this nominal revenue growth and a focus on cost cuttings, we can actually significantly increase cash flows. This gets us a valuation actually between $86 billion and $176 billion, with $115 billion being right in the middle with a 3% growth in perpetuity and a 10% discount rate. As of recording this, Nike's trading at $113 billion. So it actually appears the market may have adjusted correctly and is assuming that Nike will forego growth and search for cost cutting. I think there is a good amount of headwinds that Nike does face as well. Apparel is now heavily crowded with companies like Lululemon, Vori, On, all of those companies. And then footwear is always changing based on trends. But Nike has shown that they can maintain their market dominance for decades at this point in the footwear business. I think this will be an interesting one to watch. If you think the economy and spend will actually pick back up for discretionary goods like shoes, or if you believe another bubble will form in the sneaker market, driving more demand, then Nike could end up actually beating their own projections, and it could end up being a pretty good play. Before I enter a position though, I'm going to definitely want to double click in on those SG&A costs and see if management has mentioned any cost cutting plans to understand if management is okay accepting the reality that maybe they're no longer a growth company that should focus on efficiencies. Anyways, that's all I had for today. It's a pretty quick one. I hope you found it interesting. Leave any questions or comments below. Thanks so much for watching.